Okay, thanks everybody for attending the conference. Thank you for taking time out. I know it's a busy time of the year. It's certainly busy for us, but we appreciate you spending a little time with us as we go to a course into Introduction to Self-Funding. But just a couple of things I want to point out right away. In your screen, you should be looking at the Professional Benefit Services screen, Introduction to Self-Funding. And at the very top, if you scroll across the top, a bar will come down, and if you move to the far right of that, there's three dots, and it says More. Click on More, and you come down. There will be a chat window that you can open. So if at any point in time you have questions and you'd like to type those in, go ahead and do that. We'll try to take some questions at the end. So we'll be answering those, I think, at the end if we have time. I've got about 30 slides to go through, so it may take us the full, I'm planning on 50 minutes to an hour. And so we'll answer those kind of as we can. Also, if you have private questions that you'd like to ask at the end, I'm not sure if when the chat window comes up, if it's something that everyone will see. But if you'd like to ask something privately, at the very end, we have info@profben.com. You can also see that on the screen now. Our website or info@profben.com. And if you have private questions you'd like to ask, feel free to just email to that address, and we'll get those answered as well. So a little bit about what we're going to do today. Again, it'll take about an hour. The course today is Introduction to Self-Funding, really basic kinds of stuff. So if you know much about self-funding, then this will probably be just kind of more of the same for you. As we get into the series, we've developed a series of 4 different classes. We'll get information out to you, and there's information that's sliding on the next class. 4 of them, each about an hour long, and they'll get more and more in depth and deeper into self-funding and into some detailed kinds of stuff. So that's kind of the plan. We will use throughout this. Throughout our program, we'll use examples. I always learn best, and I always enjoy most on webinars or in conferences when people use actual examples of examples of where things worked or where they didn't work. And so as much as possible, we're going to bring those in, and I'll bring in cases that we've worked on and kind of how self-funding has helped and how it's been a solution for some folks. So we will bring in those examples. As I said, this course is pretty basic, which I think is good for everybody, but I really believe there are a lot of folks out there. We work, of course, with a lot of you, and I think there's a lot of people out there who maybe know a little bit about self-funding, maybe have a group or two, or maybe haven't done it. I think there's some folks that do it a lot, and other folks that maybe just touch on it. And so I think this is going to be a really good course, particularly for those that maybe haven't done it before or haven't been as involved, particularly if you stay through the series. So that's kind of the start of what we're doing here. Why do we want to go through self-funding? Well, I think it's in Oregon, certainly, if any of you belong to the health underwriters, we've seen an uptick of folks who are putting on these types of classes. And why? So the health underwriters are putting on classes. I was in Alaska a couple months ago. There was an Alaska Health Underwriters organization put on a 2-day seminar on self-funding classes. And so more and more folks are doing it. And why? Because I think it's becoming more popular for people to look at self-funding. And again, we'll go through kind of the reasons for that. But it's a good thing to go through today, and more folks are interested, and we'll talk about why. So the next slide, page down. Sorry, bear with us as well. This is the first time for me doing this, so we're going to thank you. So if there's any issues or anything, please call us, email us and let us know, or get on the chat. Let me know if there's any issues. It's our first time doing this, so we'll kind of work through this as best we can. So is self-funding the answer? Well, again, here's some statistics. Some of these statistics are older. I'll try to get more updated as we kind of go along. The point is that health premiums are increasing, right? And that's not a surprise to anybody on this call. You all work with clients. You know that costs continue to go up and up. And so you're looking for solutions for employers. So the two things that I think that are happening that really drive people to potentially looking at self-funding is, one is the costs continue to go up. And two is that the choices or the options that we have today as an advisor for clients are not what they were in the past. Prior to the, and I'll just use the Affordable Care Act implementation in 2014 because that's a time we all kind of saw that the business change substantially. For us, at least in Oregon, we now have fewer carriers in the marketplace than we had before. So that means less options for folks, less choice, in addition to the cost going up. And those are two big reasons that I see people really talking or looking at something else. What else can be done? And self-funded can kind of fill that void. Statistics here that I think are a little bit, to me, it helps to know, right? I always want to know what are people doing or what's typical or what's common. More than 100 million employees and their dependents are covered by self-funded medical benefits programs. That was as a 2013 study. I'm sure it's up from that since then. More than half of the U.S. employees are covered by self-funded plans. And 83% of groups or companies with more than 200 lives are self-funded. And we'll have a little more statistics here along the same lines. Reasons to self-fund, again, a couple of things. One, I talked about the very last bullet point. It gives employers another option in a market when options are diminishing. Employer can customize plan back up to the top as opposed to purchasing a one-size-fits-all policy. So that we describe the fully insured market as products on a shelf and they just pull those off and you plug and play with those products they have. But with self-funding, you can customize the program. You may or may not know when the Affordable Care Act came in, of course, it requires a lot of things from different health insurance plans. Some of those you're going to have to live with, regardless of whether the plan's self-funded or not. But there's some flexibility that we have within the self-funded marketplace, particularly as it pertains to the essential benefits that are laid out in the Affordable Care Act. So there's some customization that can happen. Employer maintains control over health plan reserves, enabling maximization of interest income. Again, we'll go through that in a slide here pretty quick. Employer does not have to prepay for coverage, thereby providing improved cash flow. Again, the difference there is when you're paying a fully insured product, just as you would be for your homeowners or your auto insurance, you pay a premium that goes out. There's nothing that comes back to you. You have to pay what they ask for, and end of story. Employer also, the next bullet point, employer is not subject to some state regulations, mandates. The issue here is self-funded health plans are regulated under ERISA, which is a federal law. So there's some things that we get to avoid there. Employer is not subject to state health insurance premium taxes, which are 2 to 3%. So again, there's a break in some of the costs right away. An employer is free to contract with other networks or pursue more aggressive cost containment strategies. The RBP that's listed there is something that's popular, and no doubt you have all heard reference to or read articles on, and that's reference-based pricing. And we get into that more with our clients as a strategy for helping contain some of those costs. So there's some reasons to self-fund. There's just some things to think about when you're looking at self-funding. Is it the answer? It may not always be the answer. I think again, here's some more statistics that are talking about folks that, the size of the groups that you want to take a look at for self-funding. Obviously, in self-funding, the big general concept is employer pays. Employers on the hook for those claims, right, when they come up. And so the smaller group that you have, the more one person can really hurt the group with a major claim. Now that's going to be mitigated by a reinsurance, health insurance, and we'll talk about that again in a few slides. But that's really the concept here. So the larger population you have, the better off you're going to be. And so that last bullet point talks about, at the end there, it talks about 100 employees was always the cutoff. I don't know how long any of you have been in the business. I know a number of you. And so I know there's some there that are getting gray like I am. I've been in the business now, it'll be 30 years here in this September. So I've been around, and I've always understood and always, and wasn't always really involved with large clients, right? I think for a lot of us, we deal with 20-person groups and 50-person groups and 70-person groups. but those 100 or more don't come along as often. So I didn't have a lot of experience with them. And what I had always understood was that 100 employees was kind of the cutoff. And that actually is dropping now with that self-funded group. So we're talking and doing proposals on groups that are 75 and below. So again, it's part of the problem that we have today, again, is that we don't have as many options as we did before, and the costs continue to go up. And to me, it's analogous to several years ago we went through the whole gas price thing, right? When gas gets up to $3 or $4 or $5 a gallon, all of a sudden alternative forms of energy start to come online, and there's because it's affordable, right? I mean, see, once insurance gets to be so expensive, then people are looking for another way to be able to mitigate those costs, and so other things start popping up, and that's what we're having now. I think that's where we are in the marketplace with health insurance today. So who is self-funding? Again, another chart to let you know and kind of go through some statistics about who is self-funding. Again, these are older numbers, so we'll try to get things more updated as we go along. Part of the slide presentation I'm using here I've given before, and we do have CE for this. I know I've gotten CE credit. I can use that. We're working through the whole piece about doing this a webinar. I've always done these kinds of things in person. So we're working through that piece to make sure that we can get CE out to you through this webinar piece. So again, the statistics are a little bit old here, but not surprising. The general overview is the very large employers, 5,000 up. Again, most of those folks are going to have it, are going to be self-insured. The smaller folks typically are not, the 3 to 199. But basically, the larger the group is, the more you would expect that they'd be self-funded. So personal story, I got reconnected with a fraternity brother of mine that when I was in college, and he was a close friend of mine. We got reconnected, been able to spend some time together. Our families will spend a little time together. And chatting with him, he's an engineer. He's got his own company. He's got about 600 employees. And we were on a hike one day, and we were chatting about business. And I was asking him the number of employees he had, and he said about 600. And as we were talking, and chatting about health insurance, sure enough, his group was self-funded, and that's what I would have expected. I would have been shocked had he said they were fully insured. So the larger the group, the more the more opportunity there is for self-funded, or the more you'd expect them to be self-funded. Okay, so now talk about fully insured. Again, none of this is going to surprise you. Anybody that deals with fully insured products knows this. So fully insured premiums obviously include claims, administrative costs, premium taxes, risk charge, and profit margin. All components, as you know, are owned and managed by the carrier. Again, they're saying, I will cover you these costs, and here's the premium that I need for these costs. And so we use their networks, we use their pharmacy benefit manager, we use everybody connected with that fully insured carrier. And so again, these are the prescription PBM, pharmacy benefit manager, case manager network. We use all of what they have. You don't get any choice in that typically. Premium is paid to the insurer without regard to whether claims are incurred or payable. Obviously, that's obvious. And then also it's obvious that unspent dollars belong to the carrier. So they're not going to give you any kind of a rebate or refund or any of that type of stuff. Whatever they get, they keep. So here's where I'll interject just a personal story. We have a client that we have been administering their self-funded plan for about 5 years. They determined early on that that on a fully insured product, carriers do not have to give you, they don't have to provide you with your claims experience. And typically they do not do that. So that when you're a certain size, if you're under 100, they don't have to give you that information. Once you get to be 100 or more, then that information is required. Interestingly enough, I know the president had a proposal, and they were looking at decreasing that number so that people could get their loss experience less than 100. But that didn't pass. It was interesting that they were talking about it, but it didn't happen. So as it stands now, 100 or more, they can get it. We had a group that came to us because they had renewal on their medical plan. They had become a group that was over 100, and so they started to get their claims loss, their loss ratios, and found out that after a year of paying in, about $1 million in premiums, they found out that the carrier had paid out about $400,000 in claims. And so there was a $600,000 that went to the carrier, and the man in charge, the administrator, was very unhappy about that, obviously, wasn't excited about that, and wanted to look at doing self-insured plans so that they could keep what they didn't have to pay out. And it's been very successful for that group. I can share with, over the 5 years we've administrated the group, they've, comparing them to what they would have paid in the fully insured market, they saved over $1 million. I think it's $1.2 million, right around $1.2 million in premium differential between what was paid out in the self-insured program they have versus what they would have paid in the fully insured. So it's been a tremendous success story for them. Okay, and self-funded. So self-funded, the opposite side to the fully insured, components of the plan are unbundled. They can be unbundled. And as you would probably imagine, there are a lot of relationships when you're dealing with a medical plan, right? There's the pharmacy benefit manager, there's case managers, utilization review. There's lots of different services that tend to go with a self-insured plan, and those can all be unbundled. Again, with the carrier, you're going to get what they have, but these things can be unbundled, and there's reasons to unbundle. We'll go over that. And here's one of those. Those components can be chosen based on efficiency. So we're not just using what the carrier has. We're able to go out to the marketplace and let competition give us the best product. There is a small fixed amount, premium amount that you're going to have to spend. Again, that we're talking about reinsurance premiums, the insurance on insurance. We'll go over that in a little bit. There's greater cash flow with self-insured. Again, we're only paying out those claims that come in. And as you would guess and you would expect, right, there's going to be times when we're going to have, where people are going to, a lot of a population is going to be spending money. They're going to have claims that come up, and there's other times when they're not. And so those times when they're not, there's cash flow that's not would have gone out in premiums that's there that they can use. And of course, the reward on self-funded plan for this one group, again, it was $1.2 million or so in over 5 years that the unspent dollars belong to the employer, and so they got to keep that. It's analogous, and I think most of you are and have dealt with health reimbursement arrangements. And so I always tell people that the health reimbursement arrangements are self-funded. They're just self-funding a plan to a much lower extent, right? So most of you know that the health reimbursement arrangements happen when an employer does not want to pay for this very high deductible or a very low deductible plan. They want to move to higher, and then they use the HRA to self-fund that to a lower deductible. And so again, it's the reward there is if people don't meet those deductibles, what would have paid out in premium stays with the employer. And those have been very, very popular. Okay, so getting into self-funded medical plans, there's 4 parts to these plans. There's stop loss. Again, we'll go over that in a minute for those that don't know what that is. There's claims. You know what claims are. That's what has to be paid. There's administration that has to be done. Somebody has to process those claims. Somebody has to process those prescriptions and do those type of things. And then there's reserves that you set aside for claims that we haven't seen yet. They're out there, and we know they're out there. We just haven't seen them yet. So what is stop loss? Let's get into that. What is the stop loss? So stop loss is basically an insurance on insurance. It protects the employer from having to spend too much money in costs, right? For their staff that goes out and has a large expense, maybe they've got heart issues or whatever, then there's reinsurance within the self-funded plans. And it really comes by in 2 different ways. There's a thing that's called a specific stop loss, and that's when a large claim is incurred by one individual. And we've got a couple slides. We've got some real good examples of that. So there is called a specific stop loss, and then there is let me click it again. Then there's an aggregate stop loss. An aggregate is when we want the employer to stop paying over the entire group. So once the entire group has met a certain amount of out-of-pocket, that's the aggregate stop loss, then the reinsurance kicks in. Just like in the specific stop loss, once an individual meets a certain amount, then the reinsurance kicks in. So the employer is protected again with stop loss insurance in 2 ways. 1 on the individual, and then 2 based on the total. So here's an example, and again, I've got a graph that's coming up on the next page that'll show this in again, it'll just bring it to a little more to light. So deductible threshold set on an individual, most common is 50,000 to 100,000, but let's just say there's a 50,000 specific stop loss on an individual. Above that, the reinsurance carrier covers 100% on the claims for the remainder of that contract year. So here's an example. Employer, they've got a specific stop loss of $50,000, and that employer incurs, or excuse me, that employee incurs 120,000 in claims in the plan year. How much does the employer pay, and what's the reinsurance carrier going to pay? And this is the answer. So the employee again, that's a specific stop loss of 50,000. The individual incurs $120,000 in claims in that contract year. The employer then is responsible for that 50,000, right? We're going to pay that 50. It's like a deductible. It's a $50,000 deductible they have on an individual, and the reinsurance is going to pick up that difference for $70,000 in that case. So that's how this specific stop loss deductible works. What about the aggregate? Well, again, the aggregate is based on, so specific is on the individual, the aggregate is based on the group, the total group together. So what is the group, what is the employer willing to absorb as far as the group is concerned? So they, first off, they determine what the projected claims is going to be. Who determines that? Typically, that's going to be your stop loss carrier. They're going to take a look at the group. They're going to determine what that group will incur during the year. A factor of 25 is usually added on, which is typically referred to as the corridor. And so that whatever the expected claims is going to be, then they add 25% to that. So you're talking about 125% of what is expected in claims, and that ends up being the maximum claims liability. Or another way to talk, another terminology is an aggregate attachment point. And so basically, once that maximum claims liability or aggregated attachment point is hit, then the stop loss carrier picks up the expenses after that. So that's a typical example of how the aggregate works. Again, individual is on the individual, and that's a specific that you would meet, and then the next thing the group has to look at would be on the aggregate. It's somewhat analogous, I would say, as I think about it, to an individual deductible. You that work in the, you've got health insurance plans, you can think about individual deductible, and you can think of maximum out-of-pocket expenses. Those are on the individual, right? It is a little bit different, but that's kind of how I think about, the specific and then the aggregate. So another visual, these slides will go very quick because again, it's visual, it's easy to see. There's an aggregate barrel. That's what the employer will pay out, which is going to be funded of expected claims, right? The projected claims out of the group. And then there's that aggregate corridor, that 25%. And then anything above that falls out of that in the red, that's going to fall on the reinsurance carrier. Okay, so those are the stop loss amounts, specific again, and aggregate amounts. Then we have to take a look at stop loss contracts. And the other important point to remember is contracts are written and based on incurred versus paid periods. And so you would know and you would understand certainly the difference between incurred and paid, right? Incurred is when I incurred that expense, when the date of service was rendered, and paid is when it's paid by administrator. And you all know this, you all understand that those are two different things, that paid certainly can happen well after incurred. In fact, that's what we will fund for those kind of things and set aside reserves for those. But that's the difference here, of course, is incurred versus paid. And so typical contract language, you're going to see something like a 1212 or 1215. There's a number of different ways that can be run out. Just understand that whatever the contract is, when you ask about the dates in the contract, what period we're talking about, the first two digits has to deal with the incurred period. The last have to do with the paid period. So 1212 would be, just as it says here, 12 incurred 12 months, paid in 12 months. We don't typically see these kinds of contracts. Usually you want to allow some time for for paid to come in after that, after the time period before, when things were incurred. Obviously, that there can be several months after incurred dates before you ever see, and before it even runs through insurance for it to be paid. Most of you know that'll take a month, 3 months for that to happen. I had surgery done, knee replacement, not that long ago, about 3 years ago. I had right knee replaced and then left knee. And in that case, it was a good 2 or 3 months after incurring the expense before I got my EOB forms and we got everything worked out so that could be paid. So again, just a difference in those dates, but that's an important concept to understand in the self-insurance world. What do those months mean? This is an example of what it would look like for a 12-15. So it's incurred in 12 months, but we're going to use a 15-month period as for when we're going to pay those things out, or get that all paid. This is another contract language that you can see that's a little bit different. Again, it's a 24-12, 24 months that the expenses are incurred in, but they're going to be paid out in a 12-month period. So again, just differences. There'll be more coming up in a few more slides, but that can be, these kind of can be all over the board. Just remember, incurred is the first 2 digits, and then paid is in the last 2. So let's pause real quick just to go over again advantages of the plans to the self-insured. Again, plans can be customized. The other thing that we didn't talk about earlier is there is a transparency in claims costs. When you're paying for when you're paying a fully insured product, and you once you send those premiums off, right, that goes. If you're less than 100, they don't have to give you any claims. You don't have to understand what's happened as far as your group has actually used. In a self-funded plan, you always know what's going on. You always get reports. You can find out what's going on within your group. Sometimes, to be honest, that tends to be a little bit that can be a little bit daunting for somebody in the at the employer to know and understand that and know that about their folks, because there are privacy issues, right? People can feel a little bit uneasy about some of those privacy issues. But that's one of the things that you do get with this is you get transparency in claims costs. How that's nice is if you have issues within your group that could be addressed, right? Maybe my group of employees, for whatever reason, has hypertension issues, or maybe there's some other issues that we can identify that have some problems, then that we could customize our plan to address those. There's a lot that people can understand and realize about their plan when they can start to get that reporting that tells them what's happening. Employer pays only for claims that they incur. Again, they're not paying out for the expenses that they don't have. It's not a premium that goes out. If you're not incurring it, we don't have to pay it. And again, there's reduced premium tax, and we do get to avoid some state issues because, again, it is covered by ERISA. This can show you an example of potential tax savings that you can get with the program. Again, right away you get some money off because we're not subject to some state taxes that we have issues with. The transitional reinsurance program fee, that of course was born by the Affordable Care Act, and we do have that. I'm not sure when. I know the PCORI fee, which is right below that ends in 2019. So we'll report this year for last year, for 2018, but I think as of 2019 that PCORI fee goes away. But those two, certainly we have those that were born out of the Affordable Care Act, and then again we get to avoid some premium tax on the self-funded side, where they have to pay on the fully insured side. So there can be substantial savings in taxes and those types of things that you would have to pay again when you're fully insured that you don't when you're self-funded. The advantages, of course, in this situation is, again, unspent healthcare dollars belong to the employer. You're not paying those out. Other thing is, again, we can plug and play. Components of self-funded plans are pretty much interchangeable. So we can, again, if there's somebody that's falling down on the job, if our pharmacy benefit manager we think is not doing the job that that we think they ought to be doing, if we're having issues there, those pieces can be changed in and out for other folks. And then accountability, of course, is a big deal because you've got detailed reporting. that's provided, and it can show you how how your group is spending those dollars, and maybe some things that you would need to change within your plan so that you can get more bang for the buck and really address needs that are within your specific group. So again, some other advantages. So let's talk about some misconceptions of self-funding plans. Self-funded plans are exempt from the ACA. That's incorrect. Obviously, we've talked about that already. Self-funded plans are subject to the Patient Protection and Affordable Care Act, although not all the ACA fees are associated with you don't have all the fees, ACA fees that are associated with fully insured plans. There's some that you get to avoid there. So while it does apply, obviously, the Affordable Care Act does apply to these plans. It doesn't to the extent it does to some fully insured plans, particularly with those fees. Self-funded plans create a greater risk for employer groups. Actually, employers' risk is mitigated again by the level of stop loss that is chosen. So some groups typically groups that get into self-funding usually want to start off, the reinsurance carriers will have good ideas of what employers could need to start with as far as specific and aggregate limits. We'll see people at 50,000, or they might start out smaller depending on what their risk tolerance is. And then as they take a look at the difference in those premiums, right, and as time goes on, they understand how that pool works, we find people that usually will increase those amounts, right? They'll go from $35,000 or $40,000 to $50,000 or $75,000 on a specific stop loss situation, and the aggregate can go from $300,000 to $350,000 or whatever. I mean, they're able to choose those. Obviously, as you would guess, when you're dealing with reinsurance carriers, just like when you're dealing with health insurance plans that have higher deductibles, you and I know that those higher deductibles come with a lower premium amount than the lower deductibles typically are, and that's going to be the same thing with the reinsurance carrier. The more risk they have to absorb, the more they're going to choose. So the important thing is to kind of get it started in those where it makes sense, right? Where dollars and cents, it just absolutely makes sense to maybe move and do some of these kinds of things, move to this kind of a model. And then as you grow and you get into it and you kind of work through it, again, then you can evaluate and decide if you want to change the amounts or the levels in the stop loss that's chosen. And it's all a function, right? The same thing that you're doing now on the fully insured stuff. You're looking at your groups, you're looking at the products that are there and deductibles, and you're making a choice based on financials from the company. Then you do the same kind of situation here. 61%, here's just a quick note, 61% of all self-funded plans run below expected threshold. So again, you're a little over half of those that are running below what is anticipated. So I will tell you, and you may know this, you may not, but typically in a self-insured product, you've got about, we tend to see, you'll have a bad year once or twice every 5 year in a 5 year cycle. So it's really nice. It's really nice if you can know when the cycles are going to happen. But even if you don't, there tend to be good years peppered in with maybe a few bad years. But again, overall, if you can take a look, like the one group that I cited that we have that saved over $1 million, and that's been through. They've had a couple of years there that weren't as good, but still overall, they've saved a bunch of money, and the employer there is very happy with the program. Self-funded plans are for very large employers. I always said, again, it was that 100 or so was what I always understood as far as when it made sense and when it didn't. But it actually is that number is lowering. So I would say for any of you that do have groups that are under that 100 mark, and you're getting a little frustrated with the lack of options and employers upset with the cost. Definitely, certainly if you've got over 100, absolutely, definitely. If you're under that, give us a call or email us, and we can chat about what's needed in those kinds of cases. But definitely, in today's market, I would take a look at everything that's out there, because again, it's expensive for people, right? Your employers are complaining about it. My employers are complaining about it. It's a cost out there that employers are looking for some answers for. And if you can bring this up, right, and if you can be a part of the solution, then that bodes well for you. And that's what you all want to do anyway, right? You want to answer your clients' questions. You want to provide them with the best possible thing. And that certainly helps keeping other people, other advisors who may be coming in and looking to, take over some of that business. So definitely take a look at it. It may not be for everybody, but we can certainly help you through that process if you do have interest. Okay, so just real quickly, we're getting close to the end of the time here. So we still have some time, but I only have about 6 slides left. So again, if you have any questions, feel free to get on that group chat and ask, or email us afterwards. There's 2 worlds of self-funding. Basically, there's a bundled approach where all self-funded concepts are with one carrier. And so who does it? It's listed down there below. Those are the companies that you can see that do that, and they're going to have everything in one shop. So everything is there. They're going to have an administrative services only contract. They will deal with specific stop loss and aggregate stop loss. They will deal with getting their pharmacy benefit manager in, and then case manager and utilization manager, they're going to use their folks. So again, it's bundled, it's all one place. And so you buy into it and you say, yep, this is what we're going to do, and you use their services. And so we would make the case obviously for unbundling that, and that's the other world that we have. So there's unbundled self-funded approach where basically those components are all chosen based on efficiency and performance. So you go to a third party to get your stop loss insurance. You go to independent utilization manager, case managers, and pharmacy benefit managers. Who does that kind of thing? Again, there's a lot of folks that are out there. TPAs, these are some big names that are out there. National companies, of course, PBS does that type of thing as well. We TPA on the medical plans, self-insured plans. There's a lot of different folks you could use as far as stop loss carriers. There's a lot out there. And I'll just stop here and say, if you're somebody who deals a lot with self-insurance, we have folks that we deal with that are very, very comfortable and understand self-insurance very well, and they'll make their own deals. They have their own stop loss carriers that they like to deal with, and so they'll do that themselves, and we just take care of the administrative services part. Others of you that may not know that, how in the heck do I know? Where do I get a stop loss carrier? How do I deal with them? We can certainly help with that. We've got resources. We can deal with that for you if you're not into that, if you don't understand what that piece is, or even how to get started. And the same with the rest of this. Utilization manager, case managers, there's companies that we deal with, and the same thing on the pharmacy benefit manager. So we have solutions in all of that. If you have questions, or if you're very uncomfortable, you say, gosh, I don't know who to go to, how would I go for even what are relationships really are there even in all of this. There's a lot more than just a few that I've listed here. Again, you can get a hold of us, and we can help you through that whole process as well. And so here again, we're fans of the unbundling. Here's just some questions that come up if you choose to place a group with a bundled carrier, right, that handles all those pieces. So again, these are just some carriers that or just some questions that come up regarding this. Who's providing the case management, utilization management? What reporting is there? Who's auditing the claims? Are there duplicated payments or overpayments? Is the carrier manipulating the plan by straddling contract periods with their different vendors, with their provider networks, that type of thing? And is your stop loss carrier the most competitive? Right, so just like there are different insurance carriers, there's different stop loss carriers, and some can be more competitive than others at times. And so those are just questions kind of to ask. And we've run into situations that weren't the best, where bundling was absolutely not the best for folks. So so there's reasons to kind of question that. So we would just point that out in this slide here. And then again, one of the last ones is, what if one or more of the bundled components doesn't perform? Then what do you do? And again, if it's all peeled apart, then you can pick and choose and replace those pieces that aren't working well. And that happens. You'll start off with one team, a group of people, and throughout a year, for whatever reason, one of those isn't performing very well. And so you have to put somebody else in its place. That's one of the things that we've always talked about from PBS, from our end. You'll use us because you want us to, to deal with some administrative issues, a benefit plan, right? Whether it's retirement or medical or cafeteria, HRA, COBRA, those types of things. Excuse me. And so we can deal with that. But the thing that I've always told clients is if we're not working out for whatever reason, you can always pop in somebody else. And that's one of the reasons, one of the big reasons that we enjoy that unbundling piece. You don't have to worry about that, right? If we're not working out, then you can replace us with somebody else. There are, and again, we're talking about separate providers for each self-funded component. We talked about flexible contract types. Again, the first of those numbers is for the incurred, and the second of the numbers is paid. So you can see a lot of different contract periods here. There's different types there. Again, if you don't understand these things, if this is something that's fairly new to you, you're really just interested in maybe looking at it for some of your clients, or you think you've got some clients that might be interested, feel free to we can walk you through all of these pieces. So it's not an issue for you to to get a hold of us and look to us to help with all this stuff. And you also have to look at other flexible contract provisions, the laser, no laser contracts. A laser is basically where you have where a reinsurance carrier is going to say, you've got an issue within your group, and although we have a specific amount that has to be met, right? The specific, what I would call a deductible on each person, and then you're going to have your aggregate over the whole group. You've got somebody within your group that we don't like. They're going to cost us some money, and so we're going to laser. So just for those people alone, we're going to have a separate deductible. So where you might have a specific deductible of $50,000, and anybody goes over that, right? Like in our example, we're going to be on the hook for. They might say for this one person, we're going to have a laser at $300,000 or whatever the number is, and then so we're not going to pay anything up until that $300,000 is met. So those kinds of things can be in contracts. Usually, it's for a fairly significant kind of a situation within the group. So again, these are all just things that you have to take a look at. There are different contract provisions, and again, certainly just understand that they're there, and this stuff can be very, very complicated. But again, these kinds of things that are things that we can help you with and kind of work through. So last few slides, again, we would say the transparent world of unbundling, it's like baseball, right? When a pitcher gets tired and can't perform, the manager replaces him. Not everybody, right? Not the entire team, just that person, because they're the only ones that are lacking. So vendors for each component, they either perform or they get replaced. And so again, one of the reasons that we would be big into that unbundling situation. So now let's talk about what's needed in a situation. So if you've got a group, right, or you've got somebody you're thinking of, or it comes across your desk, gosh, would this group be good, for a self-funded plan? Here are the things that are needed when taking a look at a group. And so obviously what's needed here is we're looking for 3 years of loss experience. And again, by law, that has to be given to you if you have a group of 100 or more. American Health Care Act, again, would have required that down to 50. That didn't pass. So it was interesting that they were looking at moving that down. I, of course, would be all for that. Why wouldn't you want it, right? And why wouldn't you want more transparency? Anyway, so this is what they're looking for is 3 years worth of loss experience, and you have to have that if you have groups of 100 or more. So what happens with that information? That information goes to the reinsurance carriers, and then they take a look at it, and they come back with really the biggest piece of the fixed cost is going to be the reinsurance premiums, right? So the bottom line of what you're going to want to get down to is fully insured plan, right? Here's a fully insured, here's what the cost is, here's a self-insured plan, and here's what the cost is. And a big piece of that is going to be the reinsurance carrier. So that information goes to the reinsurance carrier, they assess it, they come back with a contract. Again, we get to choose what levels of specific and aggregate stop loss you want to have, and then they give us a number, and then we build back from there what the potential claims are going to be, adding in that corridor, and then now we've got something we can compare premium to premium, right? So that's what happens with that process. If you're less than 100, then they're looking for 3 years of rate history. And a look at the benefit schedules, how the benefit schedules changed over the last 3 years. In addition to that, there is a questionnaire. It really basically, there's actually two types of questionnaires. One goes to there's a questionnaire that goes to the HR department. And so you would have an HR person fill it out, and they'll ask things like, do you know of anybody that has had a heart situation, or anybody that has had cancer within your group in the last 2 years or whatever. So there are questions that go along that could go along with that. Depending on the reinsurance carrier, there may be a need for a questionnaire, health kind of a questionnaire for participants. So, and I know that's not attractive, that's not fun. The more stuff that we have to ask for our clients, the tougher it is to kind of get it. But again, as these costs continue to go up and up, and if you can, if you can say, look, there's potential here to be able to save some money on these benefits. What kind of money? There's, that can range, right? That can range, but at some point in time, it gets to be significant enough where people will go through this pain point of getting you this information in order to be able to take a look at whether or not it would make sense for them. Again, from my standpoint, I think as much as the costs are going up today, and particularly as little as we have out there in competition with carriers are tending to disappear, and they're kind of becoming homogenized. We're getting, more and more rate parity within the carriers. As all of that happens, it just leaves room for another thing, and self-insurance can be a part of that. As many of you know, we're doing we added on MEC plans, minimum essential coverage plans, which came out of the Affordable Care Act. We've added that in. And why? I would have never added that in years past. I never would, because it's fairly limited in the benefits that they provide. But the problem again is that the costs continue to go up. And every time the costs go up, by national average was like 2 or 5%. I can't remember exactly, but there's a certain number of employers that just say, I'm out, I'm done, right? I just can't afford this anymore. And so when they get to that place, then then it leaves room for all these other types of things like MEC plans, or maybe like self-funded plans, other things that then have to fill that void. So it's something to take a look at. It's something to seriously consider and consider going forward. So that's really the end of it, the end of our slideshow today. So I see we're at just over 45 minutes for this, so getting close to that 50 mark. I would say again, if you have any questions, please submit those. There is that chat. If you can find that chat, if you want to do it that way, or if you want to just send us some information at info@profben.com. We're happy to answer any questions or get back to any questions that you'd have. Otherwise, our next webinar will be July 10th. Again, the expectation here is that with all of these, that this is going to grow. We're going to build on kind of basics. We'll go into more in-depth things in the next slides. Also, I don't know how many of you out there enjoy your own voice. I can't stand mine. I don't like my voice on anything recorded or anything. So we'll mix it up. I'll have Greg do parts of these, and I'll do parts of them. So we'll have more people joining in, so you won't just have to listen to me. So we'll be building, again, we'll be using more examples. We'll talk about successes, and we'll answer any questions you guys have, you folks have. So once again, I want to thank you for spending the time with us today, and thanks for listening, and thanks for your interest. I mean, again, I think we're all in that place today where we have to kind of be interested in things that potentially maybe we weren't before, but because of the times we're in, we have to do more things than we've had to in the past. Whether it's HRAs or flex plans or whatever. So thanks again, and I think that's really it. So appreciate the time, and we'll see you at the next one. Thank you.